Snow in the Great Plains and also half of the Argentinians' expected soybean production. We are going to discuss this with Mike Zuzolo right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. So, Mike, great to have you back again. I would like to start by the Black Sea issues, and later I will jump into all of the other subjects, including soybeans and corn. So, many of the surrounding countries of many of the I should say many of the countries surrounding Ukraine, they are trying to block the imports from this particular country. What's the impact of that?
Yeah, and this is where the supplies of Ukraine, they're moving west and north instead of through the Black Sea. And so you can see that Black Sea grain initiative is still impacting us in a negative way. And I think what we have to connect the dots on with this latest news about Ukrainian corn, for instance, moving into Poland, and then Polish corn moving into the rest of Western Europe. And I know for a fact that is happening. I've got a client in Sweden, in the Netherlands, that contacted me last week and said, we are getting Polish corn all the way up here in our area for our livestock feeders. And I think what we don't understand in our markets here in the United States, Luis, is the European farmers have very strict guidelines on what they're allowed to produce, and the Ukrainians do not. And so this supply moving into Europe has really impacted negatively the prices in Europe at a time when the producers there are obviously starting to plant. We've got a pretty substantial drought in parts of France. We've got a almost record-setting drought in parts of Spain. And so this is just really tough for the European producers to see. And that's why the governments of these countries, Romania, Poland, another country, maybe Belarus, I believe, is another one that may be looking at, or have already banned imports. And if they don't live by that ban, then they're going to get charged an exorbitant amount of money, they being the Polish and the Ukrainians. And so the reason I'm going into detail so much like this is I think that's really driving this market much more than the weather, like you say, with the snow up north in the spring wheat belt. And it really puts the point and the arrow on the European wheat and corn prices in Paris. They're going to, I think, lead us out of the hole. If we're going to make a major low, it'll be there first. And just this week, US CME futures in corn got within about a dime of where the Paris corn is trading right now. That's very odd. They usually carry a 40 to 60, maybe even 80-cent premium in Paris pretty much all the time. And so that's really crucial now, is to watch that European market find a low. And we'll see if we can do that as we see this grain deal once again expire in mid-May.
Yes, and now shifting to another region in South America, some of the exchanges there are reducing the soybean crop to under 25 million tons, and that's pretty significant. Argentina has sourced some of its soybeans from Brazil already for its processing industry, and also from Paraguay for about 1 million metric tons this year.
Yeah, and this is interesting. You bring these two issues up between the Black Sea wheat, which is pressuring prices, and then the Argentine beans and corn, which are keeping prices elevated and lifted. I think the real key for me right now is if Argentina is going to crush what the USDA estimates they're going to crush, or roughly 30 million metric tons. If they're going to be able to crush that amount, then the USDA Ag Attaché suggests that the Argentines are going to have to import about 11 million tons this marketing year to meet that crush number, and even maybe even more, depending on how good the crush is, how good the oil seed is in Brazil. That's a big thing, the oil content versus the protein content. But be that as it may, what I'm seeing in the soybean complex is our Pacific Northwest price here in the United States and our Gulf price here in the United States is running anywhere from 90 to $110 a ton over the Brazilian Paranagua price. And so if we want to assume that the US soybean price doesn't have to go down to meet the Brazilian competition, it really is up to the Argentine price to make that spread up, in my opinion. So if we don't see our markets fall dramatically, I would venture a guess that it's going to be because the Argentine upriver price starts to rally substantially here in the next couple 3 weeks because harvest is right there upon us, and if it's bad, it's going to be bad, and harvest is going to go very, very quickly. And I think we'll know by the middle of May what exactly is out there in Argentina's fields. And so otherwise, if Argentina's market doesn't rally, I see the US soybeans continuing to suffer unless the wheat and the corn rally, because Brazil's got such a big, big discount of $100 a metric ton right now.
Now, we shifting to the United States, even though the crop has progressed a lot more than expected, we have early, I should not say early, but we have the snow in the Great Plains.
Yeah, and this is where I was asked the question this morning, is the wheat market trading the fundamentals here in the United States, or is it trading the Black Sea and the macro fundamentals of a weaker crude oil market, stronger dollar market again? And I think it's the latter. I really think it's the Black Sea and the macro fundamentals. And the main reason is because you're looking at 5 to 10 inches of more snow in Fargo, North Dakota by this weekend. Some areas already have 3 feet on the ground. Most areas up there in spring wheat country have at least a foot on the ground, and they're not looking at warming up and for another 7 days. And so, I mean, I'm hearing in that part of the country that they may be the 1st of May before they really get anything done at all. And yet the spring wheat is the one that's helping lead the market lower today. So I don't think we're trading our fundamentals. I don't think we have been ever since the Monday afternoon crop progress and wheat rating and condition reports came out. I think we immediately jumped back into other fundamentals and other features and technicals that the funds are trading right now. And what I mean by that, Luis, you and I have talked about this a lot in the past about the technicals. We just hit the 52-week moving average in corn and soybeans and lead month futures, about 683 area and 1530 area. Those are really big numbers for me, because if we can get above those now, that should mean something in terms of maybe a shift in sentiment, and the funds tend to want to buy into the market instead of selling rallies.
Now, if we do trade the fundamentals, what would be the prices for you?
Yeah, the corn fundamentals and the bean fundamentals by the spread still look very, very strong. We've got $1 premium plus in the May corn versus the December. The ethanol data today came out the best in several months as far as production. The margins there are good. And so I think that if we can get above 683, 685 in the May corn, we should be able to go through the $7 level again. And that's kind of an area 710 to 715 is an ultimate goal of where I'd like to get pretty much wrapped up on the rest of my old crop corn that I'm holding. In soybeans, I'm a lot faster, especially if I don't see that Argentine bean price move up, because the Brazilians, between their currency and between their price at the port, and their friendlier relationship between China and Brazil now, with Lula visiting over there and Xi maybe coming to Brazil this summer, I think we're going to continue to be on the defensive when it comes to selling beans to China. So moving a little bit more quickly in the soybean complex, maybe as soon as this week, if we don't get back up above 1530.
Yes, and given that scenario, what are you seeing for production in terms of cattle production?
Yeah, cattle production is down 5%, 4 to 5%. The USDA says it's going to be down 6%. I think it could be more than that based upon the dressed weights and how high we keep the corn price in the middle of summer. I do think, though, that we are getting pretty rich right now. Lead month cattle on a monthly basis is now up 11 months in a row. Back in 2013, 2014 time period, 2015, we were able to get 12 months in a row before correcting. So we are getting long in the tooth, and we are talking about some pretty terrific cash cattle prices here in this country of above 180. And if we would go above 180 in the cash trade on a consistent basis, Louise, I think we'd see a big jump in the retail beef prices. And I'm still very nervous about a recession here in this country starting around the third quarter. And so I would say stay hedged in the cattle, especially as we get into the month of May. I think when the April contract goes off the board, I think it may be difficult to keep this rally going. We'll see what the cattle on feed report says on Friday. We're expecting both placements and on feed to be down about 5%.
And what are you going to be looking in the next couple of days?
Biggest thing next couple of days are those technicals that you and I were talking about, and whether we can actually break out of some wedge formations that are on many grain and commodity index charts in the long term. They're suggesting that as we get towards the end of April, early May, we should be breaking one way or the other. So I'm hoping we get a softer dollar and we get those 52-week moving averages in corn and beans, take those out as resistance. And that's led by the European wheat, which is helping our hard red wheat go higher.
All right, thank you very much, sir.
Thank you.